Okay, students, English medium students who are doing accounting, basically A level, advanced level in 2024. You have to now. Yesterday, up to this point, we learned up to matching concept. We learned. Now, today we will go further with those concepts. Next concept is consistency concept. Consistency in the sense you have to follow some consistent method for this. For example, you have to follow some consistent method when you are doing accounting. It's basically for the comparison purposes. Comparison in the sense you have to compare with the other periods, and for example, I will erase these things. Yesterday we learned certain up to this up to matching concept. I think all those are familiar to you now. Now when it comes to consistency concept, what happens is it's like this. Consistency in the sense I told you, you have going concern concept. That is, you are assuming that your firm or whatever your business will go far. Your business will go many years ahead, right? With the periodic concept, what you are doing is you are segregating to individual periods, shorter periods. It may be basically 12 months, like, right? 12 months in the sense 1 year. From each and every 1 year, you are calculating from it at the end of the particular year, and you get it brought forwarded to next year, and at the end of next year you are calculating the profit and loss or whatever the balance sheet, the status of account, and you get that to next year. That is the periodic concept. Segregating the entire period, because I told you, you can calculate exact figure as far as the profit and loss is concerned. You can calculate the exact figure at the end of the lifetime. At the end of the lifetime. Until such time, you cannot wait. You are segregating it to individual shorter periods, small periods, and you are calculating profit and loss at the end of each and every year, because you need to take certain decisions. Otherwise, you cannot find out where to go, what should be controlled, and what type of strategies to be followed by you. That is the periodic concept. Here, the consistency concept says the followed policies and procedures and all you have to follow with consistency. For example, uh, let's say you have chosen this type of policies and procedures. For example, the depreciation calculation method, or goodwill calculation method. I will teach you everything in future, right? Goodwill calculation, you will be calculating goodwill for the partnerships and for some other reasons, right? Whatever the revenue recognition method, revenue recognition standard, we will learn in future. There is a particular standard for that, for you to recognize the revenue and all. The revenue recognition standard and all you have to follow consistently. Consistently in the sense, if you have chosen something during this period, that should be continued to next period. So next periods also, unless you have proper argument in order to change that. That is the argument here with the consistency method. For example, if some standard or whatever the law change or whatever approves you to change that policy or whatever, or if you think that this is the better thing, rather we followed last year or last periods, then you have certain reason, right? So consistency in the sense with the same with the future periods you are following the mostly the same procedures and policies, and also it will be very beneficial for the comparison purposes with other companies. For example, let's say you have studied the standards and policies and procedures and all as far as the accounting process is concerned. When you follow some standard or whatever procedure, that also followed the same thing, followed by the other companies as well, because this is actually what you are following is generally accepted accounting policies and procedures, right? So when you are following generally accepted accounting policies and procedures, that will be very easy to compare with the other firms, with other business, and compare with the other periods, right? So that is the consistency concept. Consistently you have to follow certain procedure unless you have proper reason to change that, right? Okay. The next concept is the realization concept. Realization in the sense, actually, in the word terms, you will recognize that realization in the sense, you have to record as revenue. I told you in accounting equation, you have something called money, let's say asset, equals to liabilities. Assets equals to assets equal to liabilities, right? So when you generate some revenue in the sense, you are using the whatever invested by the owner or whatever invested by the entrepreneur, and you get that money and you invest it in the business. You get the money in the sense, your asset goes up as cash or whatever, revenue or whatever, or debtor in the sense, you have not realized that in cash, but you have that asset, debtor, that particular person's liability to pay to you, right? Then cash or whatever debtor will increase, and the liability will increase, because this particular money you are receiving, you have to pay to your owners. The particular liability is being created at the end of at the other side of the equation. Then when you are calculating, when you are receiving revenue, then that has to be paid actually to the owners, but you keep it certain time inside the business without paying directly quickly to owners, right? When you calculate or when you recognize revenue, that should be realized one. Realized one in the sense, it may be realized by cash or realizable by cash. For example, you cannot recognize revenue thinking that you will receive the revenue in future. Sometimes there is a possible that you will receive the revenue in money, or it may be vice versa, right? It may be you are unable to collect that money, right? Then if you know for sure that that revenue will receive by cash, then realization, then it will be realized. Then realization concept in the sense that revenue should be realized one or realizable one. That is the major component here, realization concept, right? So if something is there, if you have doubt of realizing, then you should not record as revenue. Then in time to come, when it comes to the questions, we will I will teach you further, right? Accrual concept. This is also very important concept. Accrual in the sense the revenue and the expenditure. Revenue and the expenditure, you have to compare. You have to compare with the relevance. For example, revenue and the expenditure should be recorded in the period in accounts on accrual basis. Accrual in the sense whatever paid or not, expenses also paid or not, but if it is relevant to the particular period, because you are matching here now, no, you recognize first you recognize revenue, and then you recognize the expenditure in order to generate this revenue. Expenditure, you are permitted to deduct that expenditure, particular expenditure which is relevant to the revenue incurring, revenue generation, right? Then when you calculate this revenue, that will be received or not, but not in the sense you know for sure that you will receive that revenue, right? Otherwise, if there is any doubt, you cannot recognize as revenue. That will be a note or something, disclosure purposes. In disclosure concept, we will disclose it in note, right? Then whatever revenue you have to recognize received or receivable, if you know for sure, right? Get the revenue for the particular period. I told you, no, in periodic concept, you are recognizing, you are considering particular time period. For that time period, you have to recognize the revenue, and the expenditure also paid or not paid relevant to that particular period. Paid or not paid relevant to that particular period, and also if that you can deduct that expenditure if you have incurred that expenditure in order to get that revenue. Otherwise you can't deduct. For example, some expenditure may be there that is not incurred to the revenue generation. For example, you have paid something for the you have paid something for the asset or whatever, which you are using that asset for longer period of time above than this period, right? So the entire expenditure you cannot deduct here. What a particular expenditure relevant to this period only you are permitted to uh, deduct here. Then the accrual concept is the revenue and the expenditure you have to recognize whether received or not, but if it should be relevant to the particular period and relevant to the particular revenue generation. The relevance is the major concept here, accrual. Then the materiality in the sense, according to the word, you will feel something, materiality. If that is material, this should be the process. If that is not material, this should be the process. Materiality in the sense, when you recognize the profit or loss, you have to follow this materiality concept. For example, I told you our business was yesterday, as we explained, the doing classes, right? This class is our business. Then you are purchasing a puncher or something, puncher, let's say puncher or something with the handle, but this can be used for longer period. That is, that period will go pass in your accounting period. For example, this is your accounting period first year. Then this puncher can be used for first year, second year, and third year, and fourth year. Let's say you are assuming that you are assuming 4 years this can be used. This can be used without any problem, right? Then what will happen? Now you have spent for this puncher 10,000. Let's say 10,000. It's very hard. Then it's very stronger one. 10,000. But the entire 10,000 you cannot deduct from your first year revenue generation. First year revenue generation from the students who have paid as payments for class. Then 10 student at 1,000, 10,000 rupees. That is the revenue you earned during first year. And also you have paid for 10,000 for the puncher. Then what will happen? The entire 10,000 basically you are going to deduct here as expense, right? Entire 10,000. Now this is material actually. This is material because your revenue is 10,000. Your revenue is 10,000. Your puncher is also 10,000. But you cannot deduct it from the first year because you are using this for 4 years. You are using this for 4 years. Then what you will do is 10,000 you will deduct to 4 years, which seems to be the depreciation. Then 2,500 you are charging for the particular year. 2,500. That is actually the matching concept, not the materiality concept. Matching concept, right? But remember, consider, but just assume that your annual or monthly, or let's say we are discussing about the annual records, no? For the first year, your revenue will be not 10,000. It will be let's say 1 million, right? 1 million. It will be 1 million. 1 million. For you, you have earned 1 million revenue for the first year. But for that revenue, you have used 10,000 puncher. You have purchased. This is not material actually with compared to your revenue. For example, 10,000 divided by 1 million. What is the materiality here? Only 1%. Only 1% out of the expenditure incurred is actually 1% from the revenue generated, not material. Earlier case, you have 100%. Your revenue is 10,000. Your puncher is 10,000. That is material. Then you have to consider the depreciation, and you will drag deducting entire 10,000 to 4 years, right? Now here 1% materiality, then it's not material actually. It's not material. If you have earned 1 million rupees as revenue, then deduct entire 10,000 from the first year. Rather depreciating for the 4 years, it's not material. So materiality concept says you think about the materiality and decide on your own what it should be comparable, right? For example, according to the general practice of the industry, some people are doing like this, but you are using the other method, saying not these are not material, and you are deducting all those things to the profit. That should not be the case. That should be comparable and reasonable. The materiality you have to decide what should do and what should not do, because when it comes to the audit, the external auditors or whoever will think about this materiality again. Then they will deduct, even though you had mentioned it as expenditure during that period. Auditor will come and say, no, that is wrong. It's not. It's actually material. You cannot deduct it from the particular period profit. You have to drag it to the 4 years or 3 years. Auditor will decide that. Right? That is the materiality concept. The next concept is prudence. Prudence concept. Prudence in the sense, actually, prudence in the sense, you should feel that this is prudent and this is not prudent. Prudent in the sense, basically, you are not overestimating your profit. Overestimating your profit. Overestimating your profit and loss, actually, let's say loss, right? Because when you overestimate the loss, that means you are recognizing the revenue halfly, or you are recognizing the revenue partly, right? Then what will happen? The owners will discourage. Owners are investing in the company, in the firm, in the business, but owners get some lesser amount than they expected. So then what will happen? Owners will discourage. You cannot purposefully reduce the profits and revenue and all, and also you cannot overestimate the profit. For example, your actual revenue is this, but you mention your revenue as what actually happened. Actually you are realizing, let's say, 1 million, but finding out the ways that you can earn more and more profits, and also you are overestimating the profit. For example, particular invoice is there, that invoice actual value is 100,000, but you mention it as 105,000, 150,000 or 200,000, and overestimate that invoice, and you create this profit more. That is not prudence, because when you create more and more profits, then what will happen? You have to pay taxes and all to government, then employees will ask certain salary increments and all. We have gained a lot of profits here. We have earned a lot of profits during this period. We need some salary increment or whatever, bonus or whatever. Then those are not prudent, actually. Overestimating or underestimating or whatever, under calculation or over calculation is not prudent. As far as the accounting is concerned, you have to calculate the proper value of the transaction. Right? Okay. The next concept is substance over form. What do you mean by that? Substance over form. Very important concept. Substance over form in the sense, form is actually what happened. Substance is the reasonability or whatever. For example, it's like this. This is basically applied to finance, lease, and leasing concepts, and the finance concepts, right? you are hiring a tractor or something, right? Let's say tractor or something for your agriculture business, right? Then this tractor will be provided by leasing company. Then there is a particular agreement called leasing agreement, and also this tractor has a book, registration book, right? This leasing company is registered under company's law, whatever under this company is registered in country's law, not it's like the negotiated transaction. It's a legal body, right? It's a legal body. You can sue against that company, and that company can sue against you. Likewise, it's a legal body, right? Book is there. The vehicle book is there. In that book, the leasing company's name will be appearing as absolute owner. Absolute owner, right? But your name is appearing here as the owner, but absolute owner is there. According to the law condition, according to law, this particular tractor is actually owned by this leasing company. This tractor owns by this leasing company because this leasing company has purchased that from outside party and given to you for your agricultural activities. You are only using that, and you pay certain lease term, that may be the lease capital and the lease interest. Altogether you are paying to leasing company, right? Substance or form, in the sense, when it comes to the leasing agreement and all, since the leasing company has the absolute ownership of the asset, you are using the asset for your agricultural activities, then this can be recorded in your balance sheet as your asset, because your name is also appearing here in vehicle registration book. Your name is also appearing here. Then substance or form concept says, basically for the leasings and finance and all certain big transactions, you can record this in your balance sheet as your asset. You have the copy of the registration, but the original registration book is kept with the leasing company, right? You have the copy of that. Until you pay the final bill at the end of the time period of the leasing agreement, that will be transferred to you through the RMV, right? RMV, vehicle registration department, right? Then, but you are using this asset for your agricultural activities, and you can depreciate this asset because you are using that asset. And we will I will teach you the accounting entries and all when it comes to the leasing calculation. But what will happen to this leasing company? Company is not recording his asset in his balance sheet as asset, fixed asset, but as debtor. Debtor is the company. We are taking that asset as on leasing basis. The debtor is actually the company. We are the company. Debtor and asset is recorded in our books, right? This is actually for this reason. For example, just think that for the entire production of the country, central bank will calculate entire production of the country. So from each and every company, central bank will be getting the information, balance sheets and all. Then this is our balance sheet. This is leasing company's balance sheet. Then in our balance sheet, we will say one tractor is there. Tractor is there. This much of value, the leasing value calculated based on the leasing agreement. And let's say the leasing company is also mentioning that tractor in their assets with the agreement value, right? Then double recorded here. Double recorded in the sense, when this central bank is taking those two separate balance sheets, he will record the entire country's asset will be tractors, this value and this value both, then that is wrong. As far as the entire production of the country is concerned, only one tractor is there, that tractor should be calculated from our balance sheet only. This balance sheet has debtor or whatever, and this balance sheet has creditor, then only that tractor value will be appearing in the entire country's balance sheet, right? So that is the argument here. Substance or form, especially for the leasing agreements, you are permitted to record that particular lease asset as your asset, and leasing company should be recorded it as debtor, right? Substance or form. Certain scenarios are there which you have to follow that method, substance over form. But remember, if this is let's assume that this is arm's length transaction with particular individual person. For example, one of your friend has a tractor or whatever, you are taking that tractor to your custody and you use that tractor, but that is actually owned by that particular person. That particular person may be asking certain fee for that, monthly fee or whatever for that, then you are using that tractor. At that particular point, you cannot mention in your balance sheet the outsider's tractor as tractor. This is permitted for special transactions only. Substance or form is permitted for special transactions only, such as leasing and finance agreements, right? This in here, what happens is your friend is there. He has that tractor in his balance sheet. That tractor is mentioned as tractor. In your balance sheet also, you cannot mention it as tractor, because that is double recorded thing. Then what will happen when it comes to the entire country scenario? Then it's double recorded. Here what happens is you have to consider only the rent paid to that particular person in profit and loss account, and here rent received or hire received, and that asset is there. Then asset can be depreciated by that particular owner. That is a separate transaction. Substance over form is permitted to particular transactions only. Remember, right? Okay. The last concept, we are closing. We are finalizing this concept lesson today, and because we have to move gradually to the sums, right? Disclosure is actually the permitted disclosures, permitted things you have to disclose in your financial statements. For example, there may be certain standards that which you require certain information to be published in your accounts. That is for the comparable purposes, because standard says this type of information should be disclosed, should be mentioned in your notes or whatever financial statements. That is for the comparable purposes, because the other company also is publishing this type of information, and that is comparable now. Your company can be compared with the other company. The central bank will take certain information from these, and the stakeholders are the owners, employees, customers, suppliers, and the government bodies, and all those are stakeholders. Stakeholders are getting certain information out of these disclosures. Certain disclosures are there required by the standards, SLAs and the IAS and all, the international accounting standards. Though those standards says definitely you have to disclose those things in your financial statements when it comes to basically the company accounts. Basically, you have to disclose the intercompany transactions, related party transactions, and taxes and all paid. Likewise, those are the disclosures permitted by standards and all. Right? Okay. Now we have completed this lesson concept in in English medium students who are doing A level accounting. Okay, we will gradually move to sums with next class, and for the time being, we stop the class and we will meet again with sums and all. And when it comes when we are doing sums, then we will teach more concepts and the practical scenarios of the applications. Right? Okay, bye for now.